If you think silver just hit all-time highs because investors suddenly fell in love with it, stop. That story is comfortable. It's also wrong. What if I told you the real reason has almost nothing to do with demand and everything to do with something quietly, breaking behind the scenes that most people never look at? Silver's move to new highs looks exciting on the surface. Headlines scream about green energy, electric vehicles, and retail investors piling in. And yes, those things exist. But if you've watched markets long enough, you know price doesn't explode like this just because demand inches higher. Parabolic moves usually come from stress, from distortion, from something being forced to reprice all at once. And that's exactly what's happening here. To understand this, you have to forget the story you're being sold and look at how silver is actually priced. Silver doesn't trade like a normal commodity. It trades like a financial instrument first and a physical metal second. Most silver transactions never involve real bars moving from one place to another. They happen on paper, futures contracts, derivatives, promises, IOUs layered on top of IOUs. For years, that system worked because hardly anyone asked for delivery. As long as traders were happy settling in cash, the illusion held, but illusions only work until they don't. What changed recently wasn't a sudden explosion in people wanting silver jewelry or solar panels overnight. What changed was pressure inside the paper market itself. The kind of pressure that exposes how thin the physical backing really is. When too many participants try to exit at once, or worse, ask for real metal instead of cash, prices don't gently rise. They gap higher. They jump. They shock. Think of it like a bank run, but quieter. No lines, no news cameras. Just institutions realizing that the silver they thought existed on balance sheets might not actually exist in vaults. When that realization spreads, even subtly, the system has to reprice fast. Not because demand surged, but because confidence cracked. Another clue is how silver moved relative to gold. In real demand-driven bull markets, silver usually lags, then slowly catches up. This time silver didn't just catch up, it snapped higher with urgency. That's not retail enthusiasm, that's positioning being unwound. That's short exposure being forced to cover in a market where liquidity isn't as deep as people assume. And here's the uncomfortable part most commentators avoid. Silver has been structurally suppressed for years, not as a conspiracy theory, but as a byproduct of how leveraged paper markets work. When supply is abundant on paper, price stays calm. When supply is questioned, price becomes violent. All-time highs don't mean silver suddenly became more valuable overnight. They mean the old price was no longer believable. You can see it in the speed of the move. You can see it in how pullbacks get bought instantly. That's not FOMO from new buyers. That's existing players realizing they are underexposed to something that can't be printed, rehypothecated, or conjured digitally when stress hits the system. So if this isn't demand, what is it really about? It's about fragility. It's about leverage. It's about a pricing mechanism that worked in calm conditions, but is now being tested. Silver isn't rising because the world suddenly needs more of it. Silver is rising because the market is quietly admitting that the old pricing model no longer works. Because once trust fades, price has to do the job trust used to do. That's the part almost nobody explains. Markets are built on confidence, not just numbers. As long as participants believe paper claims equal real metal, everything stays orderly. The moment that belief weakens, even slightly, the math changes. Suddenly, a futures contract isn't just a trade, it's a liability. And when too many liabilities point to too little physical supply, price becomes the release valve. Look at how inventories have behaved. Official stockpiles didn't collapse overnight, but they didn't need to. What matters is the trend and the accessibility. Eligible silver isn't the same as deliverable silver. A lot of metal counted in reports isn't actually available without causing disruption. When traders realize that, they don't wait for confirmation, they move preemptively. That front-running behavior alone can send prices ripping higher. Now layer in interest, rates, and currency pressure. For years, holding silver made little sense compared to earning yield elsewhere. But that calculation flipped. Real yields turned unstable. Debt levels ballooned. Currencies started losing purchasing power faster than official inflation numbers admit. In that environment, paper promises lose appeal. Hard assets regain relevance, not because people suddenly want them, but because people don't trust what they were being offered instead. There's also the role of large commercial players. These aren't emotional buyers. They don't chase trends. When they move, it's usually defensive. When silver breaks key levels and doesn't immediately collapse, that tells you something important. It tells you the sellers who used to cap price aren't as comfortable anymore. Either they're stepping back, or they're being forced to reduce exposure. Both scenarios are bullish, and neither has anything to do with solar panel demand. Notice how media explanations always arrive after the move. First, price explodes. Then analysts scramble to attach a neat narrative. Green energy, industrial usage, retail interest. Those stories sound logical, so people accept them. But they don't explain timing. They don't explain speed. They don't explain why silver ignored bearish headlines and kept pushing higher anyway. The real driver is imbalance. Too many claims, not enough certainty. And when imbalance meets leverage, you don't get slow appreciation. You get repricing events. That's what at all-time highs often represent. Not euphoria, but recognition. The market recognizing that yesterday's price assumed conditions that no longer exist. This is why pullbacks feel shallow and uncomfortable. They don't relieve pressure, they just pause it. Anyone waiting for a healthy correction based on old patterns might be waiting a long time, because those patterns were built in a world where paper control was stronger. That control weakens when participants start questioning settlement risk, counterparty exposure, and the true availability of physical metal. So when you hear someone say silver hit ATH because demand is booming, understand that's the easy explanation, not the accurate one. Demand explains trends. Structural stress explains breaks. And silver didn't just trend higher. It broke out of a long-standing cage, which raises a much bigger question, one that most investors aren't prepared to ask yet. And that question is what happens next when this realization spreads beyond the inner circle and reaches the broader market. Market dynamics change faster than people expect once that broader awareness kicks in. Because at that point, silver stops being treated like a trade and starts being treated like insurance. And insurance behaves very differently than speculation. You don't wait for the perfect price to buy insurance. You buy it because the cost of not having it suddenly feels bigger than the cost of owning it. That shift is subtle at first. It doesn't show up as wild volume spikes or viral social media posts. It shows up as steady absorption, fewer offers, tighter spreads, more hesitation from sellers who used to feel confident leaning on the market. This is where volatility can actually increase even as participation looks calm, because the depth everyone assumes there isn't actually there when tested. And this is where silver becomes dangerous for anyone still anchored to the old playbook. In the past, rallies were fated because paper supply could always be expanded. New contracts, new leverage, new ways to satisfy demand without touching metal. But when confidence in that mechanism erodes, expanding paper supply no longer calms price. It accelerates distrust. Each new promise makes existing holders more aware of how many promises already exist. This is why comparing this move to previous silver rallies can be misleading. This isn't 2011 all over again. Back then it was largely speculative heat colliding with macro fear. This time, it's structural. It's about plumbing, about settlement, about whether the market can actually function the way it claims to under stress. When markets start asking those questions, prices don't politely revert to mean. There's also a psychological component that rarely gets discussed. For years, silver trained investors to expect disappointment. Rallies failed, breakouts reversed. Anyone who stayed long felt punished. That conditioning matters. It keeps positioning light. It keeps skepticism high. So when price finally escapes that gravity, there isn't a crowded long trade to unwind. There's empty space above. That's how you get air pockets to the upside. And while retail attention will eventually arrive, it won't be the cause. It will be the consequence. By the time silver feels obvious, the easy part of the move is already behind. That's how these cycles always work. The real money moves first, quietly, driven by risk management, not excitement. The crowd arrives later, driven by headlines and hindsight. The biggest mistake now is assuming this move needs constant justification. It doesn't. Prices don't rise because everyone agrees. They rise because enough people act under uncertainty. Silver doesn't need universal belief to stay elevated. It just needs persistent doubt about the alternatives. And right now, doubt is spreading faster than confidence in almost every paper-based system. That's why focusing on daily price swings misses the point. This isn't about catching a top or bottom. It's about recognizing that silver's all-time high isn't a celebration. It's a warning signal, a signal that the market is adjusting to risks that were previously ignored or underestimated. And once those adjustments start, they rarely reverse cleanly. They evolve, they compound, and they force participants to rethink assumptions they once took for granted. Silver didn't hit all-time highs because demand suddenly exploded. It hit them because the system pricing it could no longer pret. And everything was fine. This move isn't about excitement, trends, or hype. It's about stress, trust, and the quiet realization that paper promises only work until they're questioned. When that questioning begins, price stops being an opinion and starts being a necessity. Whether silver goes higher from here isn't about how much people want it. It's about how much they distrust what's being offered instead. And that's a much deeper, much more powerful force than demand ever was.